Hal Scott. He is from the Harvard Law School. He is back with us. Hal, you say you were worried that this regulation was going to be even stronger. So while you say it's strong, you said earlier it's not as bad as it could have been. Banks can still invest in private equity. They can still invest in hedge funds. And you say there seems to be a little wiggle room as far as the prop trading goes. What do you mean by that?
Well, when you actually look at the possible exception to what might not be prop trading, where you're trading on behalf of your customer, I think you could do a lot of stuff there, even though you're deploying your own capital. So I think it's unclear exactly where the line is on prop trading, and that was the case from the beginning, actually.
Now, we know that the oversight, the new oversight of the derivatives market is pretty complicated stuff, but from your read so far into it, does it look like it's striking the right balance into helping Wall Street perhaps reduce its risk and reduce the risk to the taxpayer, but yet still let business function as normal?
Well, it's extremely complicated and detailed, and I really can't come to a conclusion on that. The one thing that I am not happy with on derivatives is the split in jurisdiction between these various agencies. Of course, from the beginning, a major failure of this reform is not changing the structure of the regulatory agencies themselves. And when you look through the derivatives, who's regulating what and what the authority is over the clearinghouses between the Fed, the CFTC, and the SEC, this is a major concern. We should have centralized the regulation of derivatives into one agency, preferably the Fed, and we didn't do it.
Hal, we thank you so much for your time, for your insights. Hal Scott joining us there from Harvard.